Hi, everybody. This is Tony Nash, and welcome to the week ahead. Today, we have a couple of very special guests. We've got Michael Gao. You would know him from Twitter as Urban Cowboy. And we've got Sam Rines, and obviously, you know Sam from previous shows. This week, we're going to talk about a lot about what's happening with inflation in markets. We're going to talk a lot about where inflation is hitting, particularly in the US in different sectors. And then we're going to cover a little bit of tech. So our key themes this week, first is the Asian and contagion for inflation. And Mike's going to jump into that in quite a bit of detail. We're then going to look at US inflation. Sam put out a really interesting note covering kind of cars versus Cracker Barrel, although that's not really the comparison, but it's something in that range. And then we're going to look at Meta's move to freeze hiring and their warning about layoffs. Kind of, is that a broader signal for tech? And finally, we'll move into the week ahead. So before we jump into this, please be aware that we have our product called CI Futures, where we forecast hundreds of commodities, currencies, and equity indices, as well as economic indicators. I was just going over our error for GBP USD for the month of September, and our error was about 2.23%, I think, for the month. So it's a very relevant product, even in these times. You can find out more on the link below. It's $99 a month, and it's, you can see everything in the subscription there. We publish our error rates, we publish our forecasts. You can download the data, you can download the charts, and do comparisons. So please check that out. Michael, thanks for joining us. I really appreciate your time. I've heard you on a number of other podcasts, and it's just so great to have you here. I really appreciate it.
Yeah, thank you, and great to meet both of you. Yeah, appreciate you having me.
Fantastic. Hey, there's a tweet that you put out a couple weeks or about a month ago, actually, looking at the Asian contagion. And it's pretty much, it was reflecting a tweet that you had put out in January, talking about your expectations for the year ahead and the setup for the year ahead. So given where, say, CNY has been over the past week or so, and the setup that you put out earlier in the week, how vulnerable is China? Are they more concerned right now about inflation? Are they more concerned about export competitiveness? Kind of, what does that look like? And as you start talking, we'll put up a chart of USDCNY as well.
Sure. Before I answer that question, I just want to take a quick step and just outline for you like where I kind of arrived at this Asian contagion thesis, right? So about a year and a half ago, I mean, I've been invested in the oil patch for quite a while, and I've expressed my bet through a long-term private equity play, because it's my belief that, years and years of underspend, and then exacerbated by this worldwide ESG push, right, and diversion of capital away from the sector, and then of course further exacerbated by all of this massive monetary and fiscal stimulus, first created oil inflation way back, right? So I started noticing this basically around the beginning of 21, and I wrote a bunch of threads about it. And then during the year, I started thinking, what are the ramifications of this? Well, the ramifications are that it's going to make our Fed more hawkish than the rest of the world, earlier than the rest of the world. And so what are the ramifications of that? Well, given that currencies are mainly driven by interest rate differentials, that would in turn create this, what I labeled a USD wrecking ball effect. And so as that thesis started kind of coming true and gathering steam throughout the year, the tweet that you referenced that I wrote at the beginning of this year was that I said, look, the setup is a scary one for this year, because we have the makings of a stagflationary / energy crisis not seen since the 70s. It's going to create tightening ahead of the world, creating this USD wrecking ball, and then we have this everything bubble to boot on top of that. And this wrecking ball really reminded me of my sort of baptism by fire into the hedge fund business. In 1997, I joined a hedge fund here in LA called Canyon, and we were, value credit based investors, and a lot of our idiosyncratic bets essentially got swamped by the macro, right? So what started as seemingly innocuous devaluations by a couple of EM countries in Southeast Asia metastasized over the course of a year and a half into a full-blown credit contagion. Except this time, what I wrote about in this thread is that what's scary is that, number one, the level of inflation that's driving this US dollar wrecking ball is much higher than before. And from my oil-centric point of view, I think a lot of it is structural. And then the second thing is that the vulnerability point. I mean, the EM countries are also vulnerable, but what's scary this time around are the developed nation currencies like the euro, the Japanese yen, and now I come back to your question, the Chinese yuan. Your question is a really interesting one that I actually tweeted about this week. Is China's in a box, just like the Bank of Japan, just like the ECB. They're all in a box because their respective economies are much weaker than ours. And so I think the big question, and I don't know when the US dollar wrecking ball is going to peak. Maybe it already has, but I suspect, though, my hunch is that maybe it's still got some legs to go, because until you reach a point where the macro fundamentals of those respective economic zones are strong enough that allow their central banks to essentially outhawk our central bank, any interventions are going to basically be just a wasted burn of their reserves. And so you saw that with the BOJ, right? They spent something like 20 billion of reserves defending their currency, and it lasted 2 days, and we're back to all-time lows in the yen. So China is really interesting because China is such a export-driven economy. One would think that with their economy on the back foot from the property crisis, from zero COVID policy, one would think that as their neighbors are devaluing and becoming more competitive versus them, that they would be more worried about their current account getting hit, right? Their current account surplus getting hit. And so you would think that they would want to let their renminbi devalue. What we saw instead, I think, was that yesterday that the PBOC had a pretty strong intervention in CNY. That tells me, I actually put a tweet out to exactly this effect. That's a big tell to me that they're more concerned about inflation. And China, just like Japan, is uniquely vulnerable in that they are also net importers of something like 80% of their energy. And so, yeah, so it's a really, they're in a tough bind. And the $1 million question is, no one knows when that day when the BOE intervened and all risk assets rallied hard. I think that was the market kind of conflating that, the all these interventions are going to be it's going to lead to the Fed also going to QE. And I put out another thought on Twitter saying that, I don't know that you can conflate that, because the Fed was happy to be the world's plunge protection team in a world where there was no structural inflation. When you've got a world of structural inflation, it becomes kind of an every man for himself dynamic, where I don't know that how much we can go help, stymie the yen or stymie the renminbi or stymie the euro's collapse by QEing here, because that'll just completely inflame inflation. And the big tell on that was, on that risk on day, what was really roofing also was oil. And so it comes back down to oil. If the Fed actually blinks and goes back and pivots, the thing that's going to moon and lead us right back to square one is oil which is what started this whole cycle in the first place.
So let me take a step back on what you said, because you just unloaded a lot, which is great. And I think Sam will violently agree with you on a lot of stuff. But what's really interesting to me, if China is worried about inflation, although this is somewhat like 2011 when they had or 2007 or whatever, when they had the pig flu and all this other stuff, and there was inflation, pressures, but China has been the source of deflation for the last 25, 30 years, right? And so if China is no longer the global exporter of deflation, then it is a dramatic change in the structure of the global economy. Dramatic. And I think so many people have missed this, that it's, this is not something that we're not going back to 2019 prices ever, right? So
that's right.
And so, but I don't really hear people talking about, China not being able to be the export of deflation anymore. And that's just one that's come and gone. That's already gone, right? And
it's not just China, it's Eastern Europe too, right? Because I wrote a thread that basically borrowed some of the thoughts from Professor Goodhart's paper about how, this was kind of a once in a lifetime demographic dividend that allowed the world and the Fed to basically, paper over every financial crisis of the last 4 decades with aggressive monetary policy, because there were never any inflationary repercussions. Mm-hmm. But as you so validly pointed out, that was due to like a once in a lifetime sort of demographic dividend that is now in secular reversal. So.
Right. And I think part of it,
and to this point, I want to jump in and just reinforce this point here, because I think it's a really good one. That China was a massive source of goods deflation globally, along with East Germany, Poland, et cetera, as they joined in following the fall of the Berlin Wall. But I think there's something really intriguing here, is that it doesn't even matter if they still continue to export some goods deflation over time. Their commodity inflation tailwind is going to be problematic. The only thing that has really saved them with a renminbi, north of 7, is that they haven't had to import anywhere near the amount of commodities that they would typically have to, right? If you're locked down, you don't have these, they have the longest commute times on average in the world in China. That is a tremendous tailwind to gasoline, food, et cetera. When you begin to reopen and have China's economy going full bore, that is a tremendous issue for the commodity complex in general, in an environment where it's already broken. It's going to be a tremendous amount of pressure on that system. And I don't think people are prepared for that either. That China is now the exporter of an incredible amount of commodity inflation over the next half decade or so.
That's actually really insightful, because commodities which they have to import they're super afraid of that, and that's oil is basically the primary factor of production for like everything under the sun.
Everything, yes,
right. Everything.
Yeah. So back to CNY. Do you think they'll kind of give in to devaluing, or do you think they will continue to fight this, which is a battle that everyone loses eventually?
That's such a hard question to answer, because if anybody can fight it, it would be China, right? Because they have a non-convertible currency, right? So I think, like, for instance, Japan is much more vulnerable, because I don't see Japan imposing capital controls, and I don't see Japan relaxing on their yield curve controls. So the only exit valve there is the yen devaluation, right? Mm-hmm. But in China's case, they have capital controls. I spoke on an interview earlier this week with Mike Nicoletos, and we were discussing about whether or not there's a porosity through the Hong Kong dollar, right? And the question, I think they have to clamp that down too, right? Because if they really want to manage the pegs, they need to really stymie capital controls. Otherwise, I think capital's just going to flow out.
Mm-hmm. So will we see a divergence between CNY and CNH?
What is the divergence? I mean, it's tiny. It's 2.02 or something.
Okay, great. I mean, I'm just wondering if CNH is trading offshore and that's allowed to freely trade or relatively freely
You know,
trade. You see that divergence.
I have to admit, maybe Sam, you have a better idea. I'm not entirely clear on what the restrictions are on CNH trading, because I'm, you know, I don't think it's completely
It's not
a free
complete.
for all.
Yeah.
Yeah.
It's not complete.
Because otherwise that divergence would be much bigger, I think.
Well, it's a spread, right? It's a proxy of a spread. And so, you know, you can see pressure on that, and you can see that pressure pushing the expectation of CNY potentially devaluing if they don't handle it. Like PBOC, they've got a lot of smart people, but policy-wise, we make a lot of mistakes, right? And so,
I mean,
you know, I don't think they'll do it elegantly.
I was just going to say that, like, I actually think that if they let CNY or CNH freely float, it would have a 9 handle on it.
At least.
I think that's where it goes.
At least. Okay, very good. Thanks for that, Mike. I really appreciate that. Let's move on to Sam. Sam, you put a note out earlier this week talking about inflation and central bank responses to inflation. And the Fed obviously seems unrelenting in their responses. Mike mentioned, as you mentioned in your newsletter and here several times. But one area you raised in your newsletter this week is kind of cars versus mid-market dining. So you talk about cars, Carvana versus Cracker Barrel. Can you kind of walk us through that? And I've got a couple of shots from your newsletter. One is on the Carvana release, and the other one is on Cracker Barrel. Actually, we only have the one on Cracker Barrel to show the group. But do you mind walking us through that?
Sure. So the impetus behind the note was really to kind of make the point that Mike made earlier, that the Federal Reserve does not care about what's going on in the gilts market, right? It is not going to come save the Bank of England and Downing Street from what they've done, right? That's not their problem, right? That's a domestic issue. And when you decide to have a massive fiscal tailwind and a monetary policy that was being highly restrictive and going to sell bonds, you know, your currency is going to fall, and that's your own problem. That's the way that the Fed viewed it. And then a bunch of Fed speakers came out and said basically exactly that, but in a little kinder tone. But the idea there, and kind of pulling that together, is that the U.S. domestic economy is still doing well. So the CarMax report was really interesting because CarMax is used autos, right? That's what they sell. And all the headlines about inflation in used autos, you know, their volumes got absolutely trashed in the past quarter. And that makes sense, right? People are, you know, there's a drawback from interest rates moving higher. I mean, it's one of the most direct things that is affected, housing and car financing. But the interesting part about it was, while the volumes were down, they still had revenues up on their retail segment because prices were higher, 25% year over year, their average selling price. Wow. So they did a really good job of kind of managing their revenues, but that speaks to the inflation problem, right? The Fed doesn't care about volumes going down if the prices are still higher. Then you kind of go to Cracker Barrel, right? Middle America, in my mind, is, you know, you can encapsulate Middle America in a Cracker Barrel. I mean, it's kind of perfect. And when you look at their release, it's pretty clear that they called out 65 and over dining down. Guess what? That's highly sensitive to inflation. They cited lower income individuals dining out less. Again, highly sensitive to inflation. And they still had their comp store sales up 6%, which is pretty good. And then you read a little further in the same sentence, and they're like, and we had pricing higher by 7%. So traffic was down. So they had negative traffic, higher prices. So that is, again, they're giving up volumes to be able to push the price and grow revs. So I think this is kind of a microcosm of the US economy. Right? It is a strong economy if you can continue to push price like that onto consumers, right? If you can grow revenues while pushing price at those levels, that's pretty incredible. And then it's pretty interesting to me because, you know, there's this whole idea that corporate America is going to slow down their price increases. Cracker Barrel basically shot that idea right in the foot by saying, hey, listen, we think wages are going to inflate 5% over the next year. That's, September to September. And that, if we're going to have comparable store sales up, right? So guess what? They're going to continue to push price. And that's where I think we kind of need to take a step back and realize, like, these inflation pressures are broadening out, and they are beginning to become embedded. Their food costs, when they forecast those, I believe that number was 8%. These are significant figures, right? These are not things that we would have thought were possible 5 or 6 years ago. They're becoming embedded. I mean, that's 2023 that these guys are thinking that. And just one more point, going back to the CarMax report, their SG&A, their costs of doing business, were up 16% year over year because they hired more people and they paid them more. So you think about, you grow revenues at 3%, but your costs are up 16%. I mean, that's a pretty big problem. So again, it goes back to the two things that the Fed really wants to get under control, including inflation, is two things, right? They talk about the vacancies to unemployment ratio. They need less hiring to happen, and they need wages to begin, wage growth to begin to subside a little bit, because that's a tailwind to consumption. So I think you're having a number of pieces working against the Fed that might not be showing up in the data, mostly because I think the data is kind of crap. But the best part is if you're kind of willing to go to that micro level to get the macro and pull the macro out of it, these trends are not going anywhere anytime soon.
So what I get out of that is I hope Cracker Barrel has digital menus. If not, I want to be their menu printer. Because every time I go into a restaurant, I wonder like how often they change their prices, right? And basically from what you're saying, it sounds like they're going to continue to push up, I don't know, quarterly, semi-annually, but they're going to continue to push these prices up based upon what's happening in the market. And I suspect they're not going to come back down.
Oh, no. And there's other ways to do it, right? You can push price by pushing less food on a plate too, right? So you can do some creative things on multiple fronts.
Shrinkflation.
Yeah, the shrinkflation. But I do think that no, you're not going back to anything like 2019.
Right. Okay.
I just want to riff off that for just a second, because I participated in a real estate panel a couple of weeks ago, and listening to these asset managers from around the world present. One big asset manager was basically saying that they're still seeing essentially even though the rent growth is slowing down, it's still growing, and for Q3 of this year, where you would think that the hiking has already kind of worked its way into the system, it's that rent growth is still annualizing at a 10% clip. So you talk about sticky. So I've had this thesis that it started with commodity inflation. Commodities have abated somewhat, and certainly will abate more if there is an Asian contagion, right? But the core stuff, which is what Sam is talking about, and also rents, that's really, really sticky. But here's the problem. When that stuff starts curling over, I really agree with you that if China reopens, you're going to see a resurgence in commodity stuff again. So I call this sort of like the core / energy tag team. And I think we're going to see this tag team effect possibly for years.
Oh, yeah. To riff off that, I called it the COVID earthquake is going to have more aftershocks than anybody really wants to admit.
Yeah, there was so much intervention. You can't just earn it out in 6 months, right? Or a year. It takes so long to work that out. So that makes a lot of sense. Guys, staying on this inflation theme, and Sam, you mentioned SG&A and wages. Meta announced yesterday that they're imposing a hiring freeze, and they're warning their employees about restructuring. So obviously now that, as of yesterday, they're the second most valuable company in the world, with Exxon taking over. But if Meta's instituting a hiring freeze, and Sam, you talked about Carvana hiring a bunch of people last quarter and their costs going up. What does that signal for tech? I watched, I think Sam, you showed me the site layoffs.fyi or something like that, to look at layoffs in tech, there are a couple of issues which we covered with Mike Green before, and you've talked about it before, Sam, where ad space is becoming, almost infinite, and these guys who are ad based have a lot of headwinds, and Meta is no different. And so that's obviously one of their headwinds, but the SG&A cost is huge, right? So
Yeah.
what do we need to be looking for with Meta and companies like Meta? And is this the beginning of the end of, the tech wage spike?
Ooh, I'll take part of that.
Okay, good.
Is it the end of the tech wage spike? I don't know that is going to be the case, simply because we don't have enough people with those skills. Even if we do have a pullback in, call it the number of hires, right?
It's like we're marketing people or whatever.
Yeah, on the marketing side, yes, but on the tech hiring front of people with programming skills, et cetera, I don't think that's going to slow down, or those are going to slow down anytime soon, at least until we have enough of them. But so maybe on the marketing side, et cetera. I would say that the Meta announcement is far more indicative of a slowdown generally in Silicon Valley startup spending on the marketing. That's a problem for Meta on the margin. They, a significant amount of their ad revenue comes from startups. It's a much larger problem for a company like Snapchat, right? There is a hierarchy of where you go to advertise and who you're, when you're going for eyeballs. So if it's a problem for Meta, it's probably a much larger problem for a Snap, in some of those smaller, less ubiquitous platforms. But it's always going to be a question of where is Meta putting its incremental dollars, because it is making a pretty big push into the metaverse. It's unlikely that people are getting jobs are getting slashed there. It's more likely that what you're going to see is a reduction in places that they're simply not seeing the returns that they want to see, and they're going to continue to grow the hiring base on something that's important to them, like building out the metaverse side of the business.
Sure. Yeah. Mike, what are you seeing with tech?
I don't follow idiosyncratic tech as much. So, yes and no. I mean, I'm actually, ironically, one of my idiosyncratic positions is actually a de-SPACed ad tech company that's in the ad arbitrage business. So it's a different type of play, but I haven't been as focused. So I'm very interested to hear your these sort of microcosmic views. Really, really interesting.
Yeah, I think everything Sam says is spot on. I do think that in terms of the core coding skills, there's a lot of slack there. So for example, as we talk around, because we hire developers, some of the developers who work for some of the very large tech companies who make mid six figures, something like that, their daily code commit is something like 8 lines of code. That's it. Okay. So these guys are not sweatboxing code. It's a very minimal amount of code they have to put in every day. So I think there are major productivity gains to be made on the developer side within these large tech companies. So maybe it's not hitting yet, but I think it will hit soon. As it always starts with marketing, right? It always starts with travel and expenses, and then it goes further. And so I think give it a few months and we could see it go further into development.
I'm curious, Sam, if this what you're seeing in the sort of tech ad slowdown, how does this compare to past downturns, past cycles?
It's hard to say because we haven't seen many significant down cycles, right? Because COVID wasn't a down cycle for ad spending. It was kind of strange, right? Social media did very, very well during that time frame, and social media was so young in 08, 09 that it's hard to really get a read there, except unless I mean you can kind of extrapolate Google. Google did pretty well in 08, 09. They took a lot of they took a lot of market share from traditional media, but I mean that was a different age. So I would say it's pretty hard to look back and say it's going to be similar this way or not similar that
But
way.
but wouldn't you say though that the ad slowdown is just across the board? It's not not as if traditional ad spending is going to start eating their lunch. Yeah,
correct.
It's across the board.
Yeah, it's across the board. Yeah.
You guys, real quick before we wrap up, if you can, in 10, 15 seconds, what are you looking for the week ahead? Mike, what are you looking for next week to watch?
Well, I think this has been a very confusing week in that I think there've been a lot of like quarter end shenanigans and window dressing.
Mm-hmm.
I'm still macro pretty bearish.
Okay.
I'm concerned that I think after the window dressing is done, I think some of the supports from the market may actually not be there.
Yep.
I watch bonds and commodities a lot as the tell.
Perfect. That makes sense.
Yeah.
Sam?
I'm watching the euro and what happens with TTF next week. I think that's really important after we get through the quarter close.
Absolutely. Guys, thank you so much. I know this is quick. I wish we could talk for 2 more hours. Hey guys, we got cut off at the very end there, so I really apologize for that. I just wanted to thank Mike Cao and Sam Rines for coming on the week ahead. Thanks guys so much for all that you contributed this week, and thanks to everybody for watching. Have a great week ahead.